Hello and welcome to Ask Me for a Trend. I'm Josh Lipton, and for the next half hour, we're breaking down the trends of today that'll move stocks tomorrow. There is a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here's some of the trends we're going to be diving into. Volatility still present on Wall Street. Investors remain cautious while watching earnings and what's happening in Washington. Stay with us for the top market trends of the day. Plus, big brand retailers are set to face tariff exposure. We're going to hear from one analyst who just initiated an Outperform rating on Walmart. And it's not just the markets that are facing a bumpy ride. America's small businesses are contending, we know, with collateral damage from reciprocal tariffs. We're taking a deep look at what's made in America and mom and pop shops are up against now. Well, big brand retailers are set to face tariff exposure and shifting consumer behavior, but my next guest says Walmart is positioned well for the potential impact. For more, let's welcome in now David Bellinger, Mizuho America's Director and Senior Analyst. David, it is great to see you. So I think you know where I have to start, David. We've got to talk tariffs. I would imagine, David, your clients are asking you all kinds of questions. These Trump tariffs, what do they mean for the retail sector? What do they mean for the retail industry? What are the ripple effects we have to think about as investors? What are you telling them, David?
Hey, Jess, thanks for having me back on. And yes, this is a widespread issue. We've gotten a lot of questions over the past week or two about just what do tariffs mean here. And it's definitely a negative, right? You've got all this noise out there. Prices are clearly going up. But right now we're hearing a lot that consumer sentiment has been weakening. And data from January, February was pretty mixed. It was somewhat negative. You also had a lapping of leap day last year. So a lot of noise in the numbers. We think March got a little bit better and the start to April has been fine. Like we've seen some stabilization here, but there's just a lot of noise out there, potentially some panic buying on the part of the consumer and maybe some pull forward in demand. It just makes the picture a lot more unclear here. There's a lot of tariff exposure in the US. These are domestic retailers, but they do source a good deal amount of product from overseas, China, other parts of Southeast Asia. So we're not seeing companies overreact just yet. And we're trying to work through all of these pieces as they come in, and there's just not a lot of clarity out there.
Uncertainty is definitely the word of the day, Data. I'm curious, though, I mean, when you look at retailers, do they look generally positioned to eat some of these costs, or no, they're going to pass it along to David and Josh? To your point, you look at the consumer sentiment surveys, it doesn't seem, like David, like consumers are they seem in not a great mood already. So I'm curious how much, if they do try to raise prices, what you think the reaction would be.
Yeah, there'll clearly be some demand destruction here. So prices go up, unit volumes tend to come down. And we haven't seen the prices get pushed through yet. The consumer is definitely aware of this, right? And talking to companies like Walmart, we were just at their investor day down in Dallas. It seems like they have the optionality not to push these through right away. And the bigger players, including them, Costco, Home Depot, Lowe's, they sort of have the optionality here. They can do it in a slow and measured way so as to not shock the consumer. But these companies are all wired to protect their margins, right? So you want to keep costs as low as possible while protecting your margin base. And that's definitely something for these larger scale players who can push back on vendors, maybe source from different countries outside of China, move their supply chains around quickly if needed to. And they try to make those guys absorb more of the cost. So me and you, we don't pay a 25% increase on a 25% tariff. Maybe it's halfway in the middle, and we absorb pieces here and there, and the consumer is able to eat this a little bit better than if there were no offsets in general.
Let's get to some specific picks, David. You mentioned Walmart. I saw that you initiated this one as an Outperform, so you're a believer here. You told your clients, delivering the complete package. What do you mean by that, David?
Yeah, thanks for the question here. So we see multiple ways to win with Walmart. So the biggest piece, you've got this core business that's really benefited from consumer trade down. And a majority of the share gains that Walmart's picked up over the past year or two, they've been upper income consumers. So that's been pretty well documented. You've got the Walmart Plus program where consumers pay $98 a year. You've seen a lot of people step into that. We think they have about 20 million paying customers. Also, Walmart, this story has become really about the alternative revenue lines within the business. And those are advertising, membership, which you just mentioned, and marketplace. And that those are the fastest growing pieces of the business. And they also layer in the highest incremental margin rate. So just think of Walmart, $700 billion global retailer. Company's been around a 4% operating margin. We see a path to get well north of 5%. And it doesn't sound like a huge difference, but on that revenue base, there's massive EPS potential. So if you're talking about $2.55 or so at the midpoint of their guidance range this year, you could easily see Walmart be well north of $4 per share. Investors want to pay a premium for that. This is becoming more and more visible. And then one last piece here, you've also got what we think is somewhat of an overlooked Sam's Club business. It's very similar to Costco. We think they have about 30 million members, and those are powering a really nice, highly incremental margin into the overall mix of the business. So it's not just the core Walmart. They've got plenty of other drivers as well, and that's why we refer to it as the complete package here.
And David, you made a convincing case there, but before I pile in, how would you explain downside risks to this one?
Yeah, it's a good question. So everyone's going to be hit in some kind of a consumer slowdown, right? We do think Walmart is well insulated here. They've got the tariff offset, plus you've got more than 60% of the business relates to grocery consumables type items. So more non-discretionary. So you've got a good core base there. But if sales were to slow, they'll get hit like everyone else. We think they'll have relatively better numbers, but we frame the downside scenario for Walmart at about $75 per share. And that's as you get sales to slow a bit, but you've also got these margin offsets and these accretive pieces of the business that aren't fully tied to the macro, somewhat secular, just given their early stage growth stories.
So you like Walmart, David. Let's also talk about Costco. That one, you're lukewarm on that one. Looks like you had a neutral rating there. And it sounds like valuation is a concern for you.
Exactly. So a couple things here. Great company. We don't think it's a great stock just because of where it's this setup here. And you've got a consumer name trading at almost 50 times earnings. So that's a big number. Walmart's in the mid 30s, also a big number, but relatively better. And so Costco, incredible operator. Their execution has been nothing short of stellar in our view. You've got these mid-single digit consistent comp numbers each and every month. And no one's really putting that up across the consumer space. But our concerns here is they do have an ads business, very similar to Walmart, but we think management has a different intention here, where you won't see all of the upside flow through to the bottom line. And in quintessential fashion, Costco puts that upside back into the member experience. So lower prices, better rewards. And that's probably the right thing to do to protect your sales base. But we think investors are expecting a little more on the flow through. And then just the valuation piece. If you potentially have a business that's set up with all these investments to have a higher leverage point, and what I mean by that is you need mid-single digit or high single digit sales in order to get margins higher. If you have that set up going into a potentially slowing macro environment, we just think that's difficult to underwrite 50 times earnings on.
And Dave, final ticker I want your take on, Target. Now that one you're neutral as well. So why are you on the sidelines there, David? And what would you need to see before getting more constructive?
Yeah, Target has massive upside potential here, right? You're talking about a stock in the mid 90s or so. Margins have been pressured. They've had slowing comp sales. We think that's a function somewhat of what Walmart has been doing with delivery and convenience and getting that customer who wants to order online. And then you've also had inventory shrink. So they have not fully fixed this. You still have a lot of product that's locked up in stores, and that's keeping a lid on the margin rate at this point. But what we'd like to see is discretionary is a big piece of this business. Almost half of the product base, half of the sales base leans more discretionary for Target. And that's where we haven't seen the recovery just yet. Apparel, home decor, electronics. So if you start to see a shift there, that'll definitely help the Target profit recovery story. But as we look at this today with all the tariffs flying around and about 50% of their products sourced overseas, we actually see some downside risk to near-term numbers for Target.
David, appreciate your time and those stock picks. Thank you.
Thanks, Josh.
Well, U.S. stocks rally for a second day. Investors focusing on tech's temporary reprieve from Trump's tariffs. Yahoo Finance's Jared Blickry joins us now with the trading day takeaways. Jared.
Thank you, Josh. Stocks closed in the green, but we got to talk about something that happened today in the technicals. That is a death cross, and I'm going to show you what happened. This is in the S&P 500. We actually had one in the NASDAQ a few days ago, and I'm going to use a little-known feature of the Wi-Fi Interactive that produces moving averages. So that is a 200-day on this year-to-date chart of the S&P 500, Josh. And now I'm going to put the 50-day, and you can see this is coming down from a higher space, and we are just crossing it today. So typically this is kind of a hairbinger of more downside prices. And a lot of times you can see, especially in the S&P 500, above the 200-day for some people is more like a bull market and below is a bear market. These aren't definitions, but just kind of rough guidelines here. And I do have some stats on how the market evolves going forward. And so I went all the way back to about 1961. I found 32 instances of these so-called death crosses. And here are the stats: 1 day, 1 week, 1 month, 1 quarter, and 1 year out. So it's actually mostly green. 1 day out, you see a negative 0.05%. That's a very small loss. But a week later, it tends to be higher by 2/3. And then a month later by about half, a quarter, 3%. So what's going on here? The stocks tend to go up. And so I also have percent positive here, 47, 53, 50. Anything under 70 actually isn't that bullish, because if stocks are going up about 70% of the time, and according to this pattern, it's only 47, well, guess what? That's a little bit of a problem there. So
go ahead, sorry.
Bottom line here, we are expecting probably more downside price action, but not a catastrophe.
So you look at the death cross. It's a sign of the apocalypse. The zombie apocalypse is here.
I'll tell you,
stock up on ammo, beef jerky.
Yeah, you could do that. Or you could look at the VIX, which came down to about the 30 level today. That's kind of a reprieve. It was at 60 last week. So that tells me things are getting a little bit better. Point number 2. We got to talk about the R word, which is recession. And I'm going to invoke Michael Gapin. He is the chief U.S. economist over at Morgan Stanley. Just interviewed him for an episode of Stocks in Translation, dropping tomorrow, Tuesday. Here's what he had to say about what he's watching for this potential recession.
The real risk, as you mentioned, is an asset price shock. Because upper income households, we're talking about roughly the top 20% of income earning households, sit on a majority of the wealth, and they also account for 40 to 50% of total spending. So I think what stands out right now in the US economy is still the level of its asset prices. It's not a leverage bubble, it's not an overinvestment cycle. So I think the real risk is if the noise and uncertainty around trade policy causes equity valuations to fall, does that upper income household say, maybe we should spend a little less and save more?
All right, so he's watching for an asset price shock. Basically, that's a big decline in stock prices, or it could be real estate, some other things. But just the decline that we've already had, I think if you were to pierce that 4,800 level in the S&P 500 that I've talked about a bunch of times, basically the low for this cycle, if you were to go down there, that in itself could tip the economy into recession, because wealthier people would not spend as much. So he's watching that dynamic.
You want to end here on the dollar.
Ooh.
We have been talking to strategists all show about.
You know what we haven't watched in a while? Watch the dollar. I haven't said that in a while. Let me just chart this, because I think the dollar's price action has been really interesting. This is the S&P 500 again, and we will scroll down to the US dollar index. But guess what? That's a very similar chart. A lot of times when the dollar goes down, especially in the bull market that started in October of 2022, that has been risk on. So the thing is, a lot of correlations change when we have these shocks in the system. Now I'm going to show you a 6-year chart so I can show you that this is the lowest price in the Dixie, that's what it's called, US dollar index, since, 2022? So basically 3 years. Now the dollar likes to trade in ranges for long periods of time. A lot of times it'll just kind of poke above or poke below and then re-enter the range. So we have gone below, and if we were to do this again, if we were to go higher, guess what? That could put any kind of kibosh on this nascent recovery we have in assets. So I'm watching the dollar to figure out what stocks are going to do next, and again, watching that 4,800 level in the S&P 500.
Now, just finally, what assets would you call out that have benefited from this weaker greenback?
I'm going to show you gold here. Okay. So in general, the precious metals, even copper as well, industrial metals have done well. So gold is down a little bit today. Let me just show you a 3-year chart here, and you're going to see that. This is just really took off at the beginning of 2024. It's going up before then and has accelerated now. So gold futures, what is that? 32.26. I'm not sure. That looks to be about right. So 32.26. That is a lot higher. I'm going to show you a max chart so we can go back to the beginning of the century there, and we've seen gold really go on some tears in the wake of the global financial crisis, in the wake of the pandemic, and now in the wake of whatever we're experiencing with tariffs.
Jared, thank you, buddy.
You bet.
Appreciate it. Stick around, much more asking for a trend that is right on the other side. While some small businesses brace for the threat of Trump's tariffs, others are expecting some tailwinds. Upway, a secondary market for used e-bikes, joins the likes of Carvana and CarMax with potential benefits from tariffs. Upway U.S. General Manager Maxim Renson joins us now to discuss. Maxim, it is good to see you. So maybe quickly just to start, Maxim, for the uninitiated, talk to us a little bit about the history of this business, what your mission and purpose is.
Yeah. Hey, Josh. So at Upway, we are the number one e-bike reseller globally. We buy refurbished e-bikes and we resell them with a pretty substantial discount online. And obviously, we ship everywhere in the countries where we operate. We're operating in 8 countries total, 7 in Europe and obviously the US. We have 2 up centers. So up centers are the warehouses where we refurbish our bikes, one in New York and one in LA. We're a Series B startup, and we launched in 2021.
So, Maxim, let me ask you, the question of the day for investors, right, it's tariffs, right? And so I think a lot of folks would be interested to hear how do tariffs potentially impact your business, Maxim? It sounds like you all would believe, listen, you'd be in a relatively more positive, favorable position.
Yeah, indeed. As you mentioned, obviously at Upway, we feel for the businesses and the people negatively impacted by the tariffs. But indeed, for us as a reseller of secondhand e-bike, we actually expect more demand in the coming months than expected, and it all comes down to our business model and the way we source, we resell, and we repair our bikes. We source in the US, we refurb/repair in the US, and we resell in the US. So obviously our prices are going to stay quite flat or slightly increase, but not as much as the rest of the e-bike market. We have a current stock, and we bought these bikes pre-tariff. There are around 3 to 4 million e-bikes in circulation in the US right now, and these bikes have been purchased pre-tariff. So obviously the value of these e-bikes is going to increase slightly. So we'll have to purchase them slightly higher and resell them slightly higher, but the increase is not going to be as substantial as the rest of the e-bike market. Obviously, for secondhand product reseller, we're going to sell faster. So we're going to impact a bit less our prices with the risk of inventory, right? So it's going to decrease the pressure on our prices. And finally, with this tariff, it's our belief that it's impacted all sectors, and one of the sectors the most impacted it's the car industry, and we expect more people to lean towards an e-bike when it comes to choosing between an e-bike and a car, and obviously with 80% of the car trips in the US being less than 10 miles, e-bikes are obviously a cheaper alternative.
So, Max, final question. You would argue, it sounds like you all would be in a kind of more favorable position regarding tariffs. Another concern for investors, Maxim, and you know this has been the U.S. economy. If the U.S. economy did suffer any kind of material slowdown, Maxim, how would that affect the business?
Yeah, obviously, it might delay for us the e-bike market reaching its full potential. At Upway, we launched the U.S. 2 years ago because of obviously the existing market. You have around 1 million to 1.2 million e-bikes sold in the US every year. So around 3 to 4 million e-bikes in circulation right now. But also we're here obviously because of the growth and the future potential of the market. If you bring these numbers that I just mentioned to the averages of Europe, you are right in front of a $90 billion market, and that's why we're here. So obviously these tariffs, they might delay the e-bike market to reach this full potential. Meanwhile, the e-bike market, the e-bike industry overall has been targeted with tariffs in the past, and as always grown every year, and even after the pandemic. So obviously, tariffs are not a bad thing or not a detrimental thing for our business, and obviously also the bike market might also profit from the fact that prices are going to increase in other industries, especially the car industry.
Maxim, we appreciate your time today and best of luck with the business.
Thank you, Josh.
Stick around, much more Asking for a Trend right on the other side.